The Great Recession was a period of marked general decline observed in national economies globally that occurred between 2007 and 2009. The scale and timing of the recession varied from country to country. At the time, the International Monetary Fund or IMF concluded that it was the most severe economic and financial meltdown since the Great Depression. The causes of the Great Recession include a combination of vulnerabilities that develop in the financial system, along with a series of triggering events that begin with the bursting of the United States housing bubbles in 2005 and 2006. When housing prices fell and homeowners began to abandon their mortgages, the value of mortgage-backed securities held by investment banks declined in 2007 to 2008, causing several to collapse or be bailed out in September 2008. This 2007 and 2008 phase was called the subprime mortgage crisis. The combination of banks unable to provide funds to businesses and homeowners paying down debts rather than borrowing and spending resulted in the Great Recession that began in the United States officially in December 2007 and lasted until June 2009, thus extended over 19 months. As with most other recessions, it appears that no unknown formal theoretical or empirical model was unable to accurately predict the advance of this recession, except for minor signals in the sudden rise of forecasted probabilities, which were still well under 50%. It was the definitive moment that pushed the U.S. economy into the Great Recession and the worst economic crisis since the 1930s. It can happen again. In fact, the current direction in federal policy suggests it even may be likely. After unprecedented policies by the government to stabilize financial markets and reserve the economic carnage, the economic recovery is approaching its 10th year, but significant headwinds threaten to undo the progress made in the aftermath of the financial crisis. These concerns can be broken down into three areas: the regulation of the financial sectors, uncertainty in the future Federal Reserve policy, and the increased speed of the revolving door between Wall Street and Washington, D.C. The crisis rapidly spread into global economic shock, resulting in several banks' failures. Economies worldwide slowed during this period, since credit tightened and international trade declined. Housing markets suffered and unemployment soared, resulting in eviction and foreclosures. Also, several businesses failed. The economic crisis started in the US but spread to the rest of the world. US consumption accounted for more than a third of the growth in global consumption between 2000 and 2007, and the rest of the world depended on the US consumer as the source of demand.